You know, it's funny. When you order a perfectly golden, crispy French fry at a restaurant, you just have this immediate expectation of like simple comfort.
Yeah.
I mean, it's just a potato, right? You cut it, you fry it, you salt it, and boom, there it is.
As simple as that.
Or so you'd think.
Exactly. So you'd think. But when you actually peel back the layers of a massive publicly traded agricultural giant like Lamb Weston, ticker symbol LW, for those tracking at home, that simple potato reveals itself as this highly volatile, multinational logistical puzzle.
It really is. It's wild.
Yeah. So today, we are putting on our Talk Tickers lenses to dissect Lamb Weston's Q4 and full year fiscal 2026 earnings call. Because, you know, figuring out how a 75-year-old potato company manages to lose core operating profit while simultaneously selling like 11% more fries in North America, I mean, that tells us exactly where the global economy is breaking down right now.
And more importantly for you, the listener, it tells us exactly where the hidden value lies for a retail investor.
Exactly. Okay, let's unpack this. Yeah, I mean, it is basically the ultimate case study in how macroeconomic forces, so we're talking geopolitics, green energy mandates, shifting consumer behavior, how all of that collides on a single plate of food.
A plate of French fries, of all things.
Right, and looking at the raw data in this earnings report, you just see a company caught in this violent tug-of-war, really, between a highly efficient domestic engine and an incredibly heavy international drag.
And that is exactly what we need to get into today.
Yeah.
So for our Talk Tickers deep dive format, we're going to look at the headline numbers first. Then we'll dig into the operational story driving those metrics, project forward through management's guidance, and finally deliver a hard, opinionated verdict on whether this is a stock you should be buying, holding, or just avoiding altogether.
Sounds good. Let's do it.
So let's jump straight into the top line data because, you know, on the surface, the revenue narrative actually looks pretty solid.
It does, yeah.
For the fourth quarter, Lamb Weston reported a 6% increase in net sales.
Yep.
And that growth was heavily driven by physical volume. So they had a 7% jump in sales volume plus a 2% favorable currency impact, which offset a 3% decline in what they call price mix.
Yeah, and that volume number is absolutely critical here.
Right, the 7% is a lot.
It is. A 7% increase in physical volume for a mature legacy food business. That is massive. But it's really the relationship between that volume growth and that 3% decline in price mix that dictates the actual quality of these earnings.
Let's pause there for the listener.
Yeah.
Because translating Wall Street jargon is what we do here. Explain price mix for us.
Sure. So price mix is essentially the measure of unit economics. If the mix is negative, which it is here, it means they're pushing more volume through the system. They're selling more actual potatoes. But the profitability profile of what they are selling is deteriorating.
I want to break that down because it's just so vital for anyone holding the stock. A 3% decline doesn't necessarily mean they just like slash prices across the board by 3%, right?
No, not at all.
It means the composition of what consumers are buying has shifted downward.
Exactly.
So, I mean, instead of a restaurant ordering premium, high margin, battered onion rings or, I don't know, specialized sweet potato fries, they are trading down to bulk, standard shoestring fries.
You hit the nail on the head.
So the company still moves the tonnage, but the margin completely evaporates.
You've isolated the exact dynamic there. It reflects a much broader defensive posture in the consumer market right now.
How so?
Well, in quick service restaurants, QSRs, your fast food chains, when they see their foot traffic stagnate, their immediate response is to aggressively promote value meals.
Right, the $5 meal deals we're seeing everywhere.
Exactly. And value meals rely on the most basic, lowest cost inputs. So Lamb Weston captures the volume of those value meals, which explains the 7% volume jump, but they sacrifice the premium margin they usually get from like limited time offers or specialized appetizers.
Wow, okay. Which completely explains the glaring contradiction in these headline numbers.
Right.
Because top line sales grew 6%, but their adjusted EBITDA actually declined by $6 million compared to the same quarter last year.
Yeah. It's a tough look.
I mean, they sold millions of pounds more product, they generated more gross revenue, and yet the core operating profitability shrank. You just don't see a divergence like that unless there is a massive structural leak somewhere in the business.
No, you don't. And finding that leak requires splitting the company's global footprint right down the middle.
Okay, let's do that.
Because when you isolate the North American segment from the international segment, you are essentially looking at two entirely different companies.
Really?
Yeah, operating in two entirely different economic realities.
All right, let's look at the home turf first, because the North American numbers are staggering to me.
They are.
In the US and Canada, sales increased by 9%. But the volume, the actual tonnage of potatoes moved, was up a whopping 11%.
Which is huge.
Huge. And because of that sheer scale, their North American EBITDA didn't shrink like the global number. It surged by 17%.
Yep.
They added a massive $45 million to their bottom line domestically. I mean, they basically had this roaring V8 engine dominating the market on their home soil.
The North American execution is undeniably strong. But any sophisticated retail investor needs to apply a pretty big asterisk to that 11% volume growth.
Oh, why is that?
Lamb Weston's fiscal year 2026 included a 53rd week.
Ah, the classic retail accounting quirk.
Yeah, exactly.
So for a listener, every 5 or 6 years, a company using a 52-week calendar has to jam an extra week into their Q4 just to realign with the actual 365-day solar year.
Right. It's just a calendar mechanic.
But how much did that extra 7 days of selling French fries actually skew the North American data here?
It artificially inflated the baseline significantly. I mean, management explicitly disclosed that this 53rd week added $86 million in sales to the North American segment alone.
Wait, hang on.
Yeah.
If the extra week added $86 million to North America, but the overall global company only saw a $41 million boost from the 53rd week.
Do the math.
That means the international segment must have had a catastrophic back end of the year to pull that aggregate number down so violently.
Your deduction points directly to the leak. The international segment isn't just underperforming, It is actively erasing the gains made in North America.
That's brutal. Let's hear the international numbers then.
Brace yourself. Internationally, net sales declined by 2%, volume was down 2%, and their price mix took a devastating 4% hit.
Oh, man.
Yeah. The extra week couldn't even mask the bleeding overseas. So to use your analogy, the North American V8 engine is running red hot, but it is dragging a massive deployed parachute across the Atlantic.
Okay, so North America's printing money, but overall profits are down $6 million because of this international anchor.
Exactly.
The math just doesn't add up unless the overseas operations are practically hemorrhaging cash. What exactly is draining the profit pool so aggressively in their EMEA region, Europe, the Middle East, and Africa?
Well, the drain is coming from 3 distinct compounding macroeconomic shocks.
3 of them. Okay, lay them out for us. What's the first one?
The first is a fundamental deterioration in European consumer demand. Restaurant traffic across the continent is just soft right now.
Like how soft?
During the quarter, QSR traffic declined 2% in both the UK and France and 1% in Italy.
A 1% or 2% drop in foot traffic sounds basically negligible to a retail investor checking the headlines.
It does, yeah, on paper.
But in heavy capital-intensive manufacturing,
a
2% drop in volume doesn't mean a 2% drop in profit.
No, at all.
It means a severe blow to your fixed cost absorption.
Exactly. Think about the physical infrastructure of a French fry processing plant.
Okay.
You are looking at a facility spanning hundreds of thousands of square feet. It's equipped with massive industrial fryers, thousands of gallons of specialized cooking oil kept at precise boiling temperatures, and enormous flash-freezing ammonia tunnels running constantly.
Just massive energy sinks.
Right. And the thermodynamic reality of that facility is that the baseline energy and maintenance costs are essentially static.
Right, because it costs the exact same amount of electricity to keep a 50-foot fryer at 350 degrees, whether you push 10,000 pounds of potatoes through it an hour or 8,000 pounds.
Precisely.
You can't just turn down the heat by 2% when European demand drops by 2%.
And that is exactly where the margin gets crushed.
Right.
Because when volume drops, your denominator shrinks. You are spreading those massive static fixed costs over fewer individual French fries.
So the cost to produce every single fry just skyrockets.
Yes. That is why factory utilization rates are the holy grail of heavy manufacturing. If a plant drops from, say, 95% utilization to 85%, the profitability doesn't just dip.
It falls off a cliff.
Exactly, it falls off a cliff.
So the European factories are running cold, or at least highly inefficiently, because the consumer isn't showing up.
Yeah.
That's the first shock. What's the second?
The second shock is geopolitical supply chain disruption, specifically the crisis in the Middle East and the Red Sea shipping lanes.
Oh, wow. I always find it fascinating how global conflict instantly ripples into the most mundane consumer goods.
It really does. Everything is connected.
Because they ship thousands of tons of heavy frozen product globally. I imagine rerouting a temperature-controlled cargo ship around the entire continent of Africa instead of going through the Suez Canal. I mean, that completely destroys the margin on a low-cost item like a frozen potato.
It obliterates it. Management cited a severe spike in incremental freight costs specifically tied to the Middle East conflict.
Yeah, that makes sense.
The longer transit times require more fuel, more labor, and extended refrigeration costs.
Which are huge.
Exactly. And speaking of fuel, that ties directly into another really bizarre supply chain shock impacting their cost of goods sold.
What's that?
Green energy mandates.
Wait, what? How do green energy mandates impact a company that fries potatoes?
Right. It sounds crazy, but it comes down to the global market for edible oils.
Okay, I'm listening.
To meet aggressive climate targets, there is a massive subsidized push for biodiesel fuel globally right now.
Right.
And biodiesel relies heavily on vegetable oils like soybean oil, canola oil as a primary feedstock.
Oh.
Yeah. This surging demand from the energy sector has placed a massive floor under the spot prices for all edible oils globally.
So because governments want more green fuel for trucks and generators, the raw material used to fry a potato is now competing directly with the energy sector.
Yep.
That is a wild connection.
It really demonstrates how exposed a food manufacturer is to entirely unrelated industries.
Absolutely.
And while Lamb Weston's CFO, Jim Gray, noted that they are partially hedged on their oil inputs, those hedges eventually roll off.
Right, they don't last forever.
Exactly. So when they need incremental supply to cover production, they are forced to buy edible oil at these elevated biodiesel-driven spot prices.
Which just further compresses their international margins.
Exactly.
Okay, so we have European factories running inefficiently due to soft demand.
Check.
We have frozen cargo ships taking massive, expensive detours to avoid geopolitical conflict.
Check.
And we have cooking oil prices artificially inflated by biodiesel demand.
Yep.
I mean, that alone explains a brutal quarter. But you mentioned a third shock.
I did. And the third shock is rooted in the inflexible nature of the agricultural cycle itself.
Okay.
During the quarter, Lamb Weston had to take a massive $33 million pre-tax charge, primarily related to raw potato inventory write-offs.
Wait, $33 million of potatoes just written off?
Just written off.
How do you end up with that much excess inventory? Do they just buy blindly?
No, you have to look at the mechanics of potato farming. You cannot manufacture a potato on demand.
Sure.
They are planted in the spring and harvested in the fall. A company like Lamb Weston contracts with farmers for massive acreages well in advance, all based on their projected demand.
Okay, so they lock it in early.
Right. And last season, the crop yields were exceptionally high. The earth simply produced a lot of potatoes.
Which usually would be good, right?
Normally, yes. But as we discussed, consumer demand in Europe softened.
Oh, man. So they are trapped.
They're completely trapped.
They contracted for a massive volume of raw potatoes. The harvest was huge. But the restaurants aren't ordering the fries.
Exactly.
So they have millions of pounds of raw potatoes sitting in climate-controlled storage bunkers, trapping capital, and eventually, they just rot.
Yeah, they degrade. They degrade to a point where they can no longer be processed into a premium fry that meets a QSR's strict specifications.
Because fast food places are very picky about fry length and color, right?
Very picky. So the company is forced to take the financial hit, clear the storage, and write the inventory down to zero.
$33 million down the drain.
And wrapped into that $33 million charge were also the startup costs for a brand new state-of-the-art facility they just activated in Mar del Plata, Argentina.
Wow. So they are paying tens of millions of dollars to throw away last year's potatoes while simultaneously eating the heavy front-loaded capital costs of turning on a brand new factory in South America.
It's a perfect storm of expenses.
The international EBITDA drop isn't just a leak, it's a structural bleed.
That's a good way to put it.
Which begs the question, if you are holding this stock right now, is management just shrugging their shoulders and blaming the macro environment, or are they actually actively fixing the foundation?
No, they are actively fixing it. They are executing a highly aggressive structural overhaul under a strategy they call Focus to Win.
Focus to win. Catchy. What does it actually mean?
The primary objective is to physically cut the dead weight out of the network. A year ago, they announced a goal to deliver $250 million in structural run rate cost savings by fiscal 2028.
I mean, setting a $250 million target is easy for a CEO to do on a slide deck. The hard part is actually extracting that cash from a legacy operation without destroying the core business.
Very true. But they are delivering ahead of schedule.
Really?
Yeah, on this call, they announced that in year one alone, they achieved over $100 million in structural savings.
Wow. Where's that coming from?
They are ruthlessly targeting their manufacturing cost per pound and stripping out overhead in their SG&A. But the most significant move they made, the real pruning of the network, if you will, was the announcement that they are permanently closing an older facility in Broekhuizen-Vorst in the Netherlands.
Closing a European plant.
Yep.
Okay, if I'm an investor, is this plant closure a red flag signaling a company in retreat, or a green flag showing a management team finally willing to protect their cash flow?
I would say the data points firmly toward it being a necessary, deeply pragmatic green flag.
Explain that.
That single facility in the Netherlands represents roughly 10% of their entire EMEA production capacity.
That's a big chunk.
It is. And it is an older legacy plant, which means it is almost certainly less energy efficient, requires more maintenance capital, and operates at a higher cost per pound than their newer assets.
This loops perfectly back to your point about factory utilization and thermodynamics.
Exactly.
If the European market is oversupplied and demand is soft, keeping an old, inefficient plant running at 70% capacity drags down the margin of the entire European portfolio.
Right.
So by taking 10% of their capacity completely offline, they force that remaining volume into their newer, highly efficient plants.
Precisely. Management stated their goal is to push the utilization rates of the remaining European network back up into the high 80s or low 90s percentage range.
That makes total sense.
Yeah, and at those levels, even with softer consumer demand, the unit economics of a modern French fry line become highly profitable again.
They are shrinking their footprint to expand their margin.
That's exactly what they're doing.
And we know this isn't a company in secular decline because of what is happening back in North America, right?
Right.
Like if the global appetite for French fries was permanently shrinking, you would see it on their home turf.
Absolutely.
But their domestic volume was up 11%. They weren't just riding a wave. They're actively taking market share from their competitors.
They are, and they're capturing that share through a dual strategy of customer retention in the value tier and disruptive product innovation at the premium tier.
Okay, stop right there. Disruptive innovation in the frozen potato space.
I know.
That sounds like serious marketing spin. I mean, how exactly do you disrupt a French fry?
Fair question. It comes down to aggressively managing that price mix metric we discussed earlier.
Okay.
While the overall market is trading down to value meals, Lamb Weston is proactively pitching highly specialized, limited-time offers, LTOs, to their restaurant partner.
Oh, like special promotional items?
Exactly. These are unique cuts, custom batters, or specialized seasonings that allow a restaurant to drive foot traffic and command a premium price point.
Which pulls Lamb Weston's margin back up.
Exactly.
So when a fast food chain suddenly advertises a ghost pepper waffle fry for 4 weeks, that is Lamb Weston engineering a high margin burst of volume behind the scenes.
That is exactly what that is. Furthermore, they're aggressively expanding their Alexia brand.
I know Alexia, you see them in the frozen aisle.
Right. And specifically, they are pushing their premium products like fries, par-fried, and olive oil into both grocery retail and higher-end food service channels. They are capturing the health-conscious consumer who is willing to pay a massive premium for a perceived cleaner ingredient profile.
So they basically offset the margin pressure of those cheap bulk QSR fries by selling olive oil sweet potato fries to upscale grocery shoppers.
Exactly.
That is incredibly smart portfolio management.
It is.
And it seems to be resonating with their clients.
It is deeply resonating. Management highlighted that their net promoter score, their NPS, which, measures how likely a customer is to recommend their business, it has increased over the last year in the U.S.
That's a good sign.
Yeah, and it currently stands as the highest among all major competitors in their sector.
Wow.
Their customers clearly trust their execution.
Okay, let's synthesize the reality of this business as it stands today for our listeners.
Let's do it.
The international parachute is heavy. Soft European demand, Red Sea freight spikes, biodiesel inflation, and rotting potato inventory have hammered their overseas margins.
Yep, that's the bad news.
But management is fighting back by aggressively amputating their oldest, least efficient European assets, forcing volume into modern plants to fix their fixed cost absorption.
Correct.
Meanwhile, the North American V8 engine is generating massive volume, stealing market share, and leveraging premium innovations to keep the cash flowing.
That is an uncompromisingly accurate picture of their current operational stance.
Oh, good. Which brings us to the most critical and arguably the most brutal part of the earnings call for any retail investor, management's guidance for the future.
This is where the rubber meets the road.
Right. Because we know what they're doing to fix the machine, but we need to know exactly when those fixes will hit the bottom line. Let's look at their fiscal 2027 projections, because if you are holding this stock, you really need to brace for a very bumpy first quarter.
You do. The immediate future requires a strong stomach.
Yeah.
But let's look at the full year picture first to establish the baseline.
Okay.
For the entirety of fiscal 2027, management is projecting net sales to be essentially flat, with potential upside of just 1%.
Flat to 1% growth on a $6.5 billion base.
Yeah.
I mean, that is about as uninspiring as the top-line projection can get.
It isn't designed to inspire, to be honest. It's designed to be a highly defensive, conservative floor.
Okay.
They are guiding for adjusted earnings per share EPS to land between $2.90 and $3.25.
All right.
They expect adjusted operating income between $720 million and $800 million, and full-year adjusted EBITDA between $1.1 billion and $1.2 billion.
Okay, so they are telling Wall Street, look, top-line revenue is going to stall, but we're going to engineer flat or slightly higher earnings by wringing more operational profit out of the existing revenue base.
Precisely.
As an investor, whenever I see a forecast like this, my very first question is, what is the fundamental macroeconomic assumption holding this entire model together?
And that is the most crucial detail of the entire earnings print right there.
Yep.
Management explicitly stated that their entire fiscal 2027 forecast is built on the assumption of absolutely flat global restaurant traffic.
Wow. So they are not baking a miraculous consumer recovery into their numbers at all.
Not at all.
They aren't assuming interest rates drop and everyone suddenly starts eating out 4 nights a week.
No. They are looking at the current sluggish reality and accepting it as the baseline.
That's actually pretty refreshing.
It is. The CFO detailed the current state of U.S. restaurant traffic on the call, noting a really interesting internal dynamic within the QSR space.
What's that?
Well, overall traffic is flat, right? But beneath the surface, chicken-focused restaurant traffic was actually up 3%.
Oh, like your Chick-fil-A's and Popeyes.
Exactly.
Yeah.
While traditional burger traffic declined by 4%.
That is a fascinating micro trend.
Right.
The consumer is rotating away from beef and toward chicken, but the overall pie isn't growing.
Exactly.
And since Lamb Weston sells fries to both the chicken joints and the burger joints, they just feel the net zero effect of that rotation.
Yep, they just capture the flat aggregate. And by anchoring their guidance to that flat traffic, they give themselves a very achievable hurdle rate.
It is a classic strategy of under-promising to leave room for operational outperformance later on.
Right.
However, the path to that full-year performance is going to be incredibly front-loaded with pain. Management was brutally transparent about the upcoming first quarter.
They had to be.
So this is the warning sign we need to flash for anyone looking at their portfolio today. Q1 is going to look ugly on paper.
Very ugly.
They expect Q1 net sales to be flat, but they are guiding for EBITDA to decline in the low teens.
Double-digit drop.
A double-digit drop in profit right out of the gate in the new fiscal year.
Yeah.
Why is Q1 taking such a massive hit?
Well, the drop is driven by a mechanic management calls the 30% carryover effect.
Okay, what is that?
It goes back to the rigid timing of the agricultural cycle we talked about earlier.
Right, the $33 million write-off for last year's excess potatoes. Does this mean they're still bleeding cash from that same harvest?
Yes. Because potatoes are harvested in the fall, the cost of the raw material they process in Q1, which, falls in the late summer and early autumn calendar months, that cost was locked in during the previous year's expensive oversupplied crop cycle. They're still actively chewing through that older, higher cost inventory stored in their bunkers.
So it just takes time for the newer crop, which they are currently harvesting at more favorable economics, to actually work its way through the manufacturing line and onto the financial statements.
Exactly.
So they are basically trapped processing last year's expensive potatoes while trying to sell the finished fries into this year's flat demand consumer market.
You got it.
And on top of that, they're still absorbing the unhedged spot price inflation for the edible oils we discussed earlier.
Exactly. The volatility from the Q4 biodiesel spike is carrying over into the cost of goods sold for Q1.
What a nightmare.
Yeah, high legacy potato costs and high current oil costs are converging simultaneously, which is just compressing the margins severely for the next 90 days.
But the narrative management is pitching is that Q1 is the absolute trough, right?
That is the core of their thesis, yes.
Okay.
Once they burn through the expensive inventory from last year, and once they fully transition to the new crop, which, by the way, early indicators show is yielding well in both North America and Europe, their raw material costs will reset favorably.
That's the light at the end of the tunnel.
Furthermore, the structural cost savings from taking that inefficient Netherlands plant offline won't fully materialize until the back half of the year anyway.
Okay, so profitability is going to take a scheduled beating in the short term.
Right.
Now, in heavy manufacturing, when your margins compress like this, your primary directive has to be protecting your cash flow to avoid taking on toxic debt.
Absolutely.
How is Lamb Weston defending their balance sheet while they wait for these cost savings to actually kick in?
They are executing a massive pullback in capital allocation.
Okay, give us the numbers.
Their capital expenditures CapEx dropped by more than $240 million year over year, down to $410 million for fiscal 2026.
They slashed $250 million in spending on physical assets in a single year.
Yep.
That is a massive braking maneuver for a company that normally have to constantly reinvest in heavy machinery.
It is. And they are cementing that discipline moving forward.
Really?
Yeah, they announced a hard cap on new accrual investments at $350 million annually.
So they're tightening the belt permanently.
Exactly. They're pivoting away from massive greenfield expansion projects like, building entirely new factories from scratch and focusing capital strictly on what they call debottlenecking existing lines.
Debottlenecking. That is the ultimate sign of a management team focused on return on invested capital.
It really is.
Because instead of spending $150 million to build a new plant to get more capacity, you spend $15 million to upgrade the freezing tunnel and the packaging line in an existing plant so it runs 20% faster.
Exactly.
You squeeze more volume out of the concrete you already poured.
It is the definition of capital efficiency. They are applying strict, rigorous ROI thresholds to every single dollar leaving the company now.
And what's the result of that?
Well, the result of this aggressive cash preservation strategy is undeniable.
Okay.
Despite the international supply chain nightmares, the flat consumer demand, and the potato write-offs, Lamb Weston still generated a massive $537 million in free cash flow and $943 million in operating cash flow for the year.
Wow. Nearly $1 billion in operating cash flow while dragging a heavy international parachute.
Right.
I mean, that proves the underlying cash generation power of this business is incredibly robust.
And it really is.
But, a shift from aggressive expansion to ruthless capital efficiency doesn't just happen on its own.
No, it doesn't.
It requires a fundamental rewiring of the corporate culture. So who is actually driving this discipline internally?
The shift is being orchestrated at the board level. A major focus of this earnings call was the commentary from Jan Kreps, the newly appointed executive chair of the board. Kreps comes to Lamb Weston with over 20 years of executive experience from ADI Anheuser-Busch InBev.
AB InBev, the beer guys.
The beer guy.
Oh, wow. If you follow corporate turnarounds, that name means one thing. The absolute kings of cost-cutting and margin expansion.
Exactly.
If a board brings in a 20-year AB InBev veteran to be the executive chair, the mandate is painfully clear to everyone in the building.
The mandate is zero waste execution.
Yeah.
To drive this, Kreps brought in a new chief strategy and technology officer, Amit Phillip, who has a deep background in consulting, tech, and food manufacturing.
Okay.
Together, they are forcing two major strategic operating philosophies down the throat of this 75-year-old potato company.
I'm intrigued. What's the first one?
The first is a shift to a zero-based cost culture.
Zero-based budgeting. This is the classic private equity playbook, but it's rarely implemented well in legacy public companies.
Very rarely.
Let's explain the mechanics of this for the listener, because it completely changes how a company values its own cash.
Sure. So in a standard legacy corporate environment, budgeting is incremental and highly political.
Right.
If the marketing department had a $20 million budget last year, they start this year by asking for $21 million to cover inflation and maybe a new initiative.
Right, and management only scrutinizes that $1 million increase.
Exactly. The base $20 million is assumed to be an entrenched...
It's like living in a house for 10 years. The attic just fills up with junk, and nobody ever audits whether you actually need the stuff in the boxes. You just build a bigger shed to hold the overflow.
That is a perfect analogy, yes. Zero-based budgeting is the equivalent of forcing the entire company to move to a new house every single year.
Every year.
Every single year. You cannot just pack the junk in the attic and bring it with you. You have to physically hold every single item, evaluate its immediate worth, and justify paying the movers to put it on the truck.
So every single fiscal year, the marketing budget resets to absolute zero. If the CMO wants $20 million, they have to build a business case from scratch, proving how every single dollar of that $20 million will generate a specific return on investment in the current market environment.
Exactly.
If a legacy ad campaign isn't working today, it doesn't get funded just because it was funded last year.
Right. It is a brutal, exhausting way to run a department, honestly.
Okay.
But it is an unparalleled mechanism for driving margin expansion and unearthing hidden cash.
Right.
It forces every mid-level manager to operate like an owner, constantly auditing their own inefficiencies.
Man, if they can successfully transplant that AB InBev zero-based culture into a legacy farming and manufacturing operation, the margin upside over a 5-year horizon is just massive.
It really is.
Okay, what is the second strategic philosophy Kreps and Philip are implementing?
They're executing a country cluster strategy.
A country cluster strategy.
Yeah. Historically, Lamb Weston expanded globally by simply trying to sell fries in as many international markets as possible.
That's a shotgun approach.
Right, a shotgun approach. Kreps is ending that. He explicitly stated they are doing rigorous analytical work to group their global footprint into specific clusters and dictating incredibly strict roles for each cluster based on where they have a legitimate right to win.
So they're triaging the map, basically.
Exactly.
Instead of treating every country as a growth opportunity, they are prioritizing resource allocation.
Precisely. One cluster might be designated for aggressive capital investment and market share acquisition.
Okay.
Another cluster might be classified strictly as a cash cow operation, so no new investments, just optimize the existing assets for maximum cash flow.
Right.
And perhaps most importantly, they will identify underperforming clusters that lack a strategic moat and potentially exit them altogether through divestitures or joint ventures.
Wow. They're acting like an activist hedge fund inside their own company.
They really are.
Taking the massive $537 million in free cash flow generated by the North American V8 engine and walking through the struggling international segment with zero-based pruning shears, just cutting away the dead weight.
It is a highly aggressive, deeply necessary structural realignment.
Which brings us perfectly to the bottom line segment of our Talk Tickers analysis.
Let's bring it home.
We have examined the headline divergence between North America and international. We've unpacked the macroeconomic headwinds of European demand, Red Sea logistics, and rotting potato crops.
Yep.
We've seen the Q1 warning light flashing, and we've analyzed the new ruthless capital discipline being enforced by AB InBev veterans.
All of it.
Now, it is time to deliver an actionable verdict for you, the listener. Based on everything in this earnings print, are we throwing in the towel on this potato giant, or are we buying the dip?
Looking comprehensively at the massive cash generation, the market share expansion in North America, and the severity of the structural cost cutting, the data points to a cautious, long-term bullish signal.
Cautious, long-term bullish.
Yes. However, it must be approached strictly as a fundamental turnaround play that requires significant patience.
I think that is exactly right. This isn't a tech darling that is going to double on a hype cycle next week, you know?
Yeah. No, definitely not.
It is a gritty margin expansion story. So let's make this actionable for the listener right now. If you currently hold Lamb Weston stock in your portfolio, what is the play?
If you are holding the stock right now, the absolute worst thing you can do is panic sell when the Q1 earnings hit the wire in a few months.
Because the headline is going to read, Lamb Weston profits plunge double digits.
Exactly. And retail investors who only read headlines will dump the stock.
Right.
But you have to remember, management has already thoroughly telegraphed this decline today.
The market algorithms and institutional investors know the Q1 EBITDA will drop in the low teens.
Right. The pain of chewing through the old expensive potato inventory and the unhedged edible oil is already priced into their conservative guidance.
So if you panic sell on the Q1 print, you are falling into a classic psychological trap, selling the bottom right as the company finishes taking out the trash.
Exactly. The worst time to exit a turnaround story is the moment they finally write off the bad assets and take the hit.
Okay, what if you are a listener who doesn't own Lamb Weston right now, but you are looking for a value play to add to your portfolio?
If you are looking to initiate a position, the strategic move is to wait for that inevitable Q1 dip.
Try to time the bottom.
Well, even when bad news is fully guided for, human emotion often causes the market to overreact to the actual numbers.
Fair point.
Let the weak, uninformed hands sell off in Q1. The back half of fiscal 2027 presents a massive inflection point.
Because that is when the cost savings from the Netherlands plant closure hit the bottom line.
Right.
And the raw material costs reset with the new potato crop.
Exactly. And the zero-based budgeting efficiencies start to really compound.
So buy when the news looks the absolute ugliest, right before the underlying math inevitably improves.
That's the play.
Let's synthesize the core investment thesis for why a long-term investor should believe in this turnaround. What is the fundamental bull case here?
The first pillar of the bull case is the total lack of macroeconomic reliance in their guidance.
Expand on that.
By anchoring their projections to an assumption of flat restaurant traffic, management has proven they are not waiting for a miraculous consumer recovery to save their margins.
Right. Their path to profitability is entirely internal.
It's a self-help story. They control the controllables.
Precisely. They control the zero-based cost cutting. They control the closure of inefficient European plants.
Yeah.
They control the shifting of volume to highly profitable new facilities in Argentina and Inner Mongolia.
Exactly. And because they aren't relying on a rising economic tide to lift their boat, their execution risk is isolated to their own operational competence.
And when you are betting on operational competence, you are really betting on the people running the ship.
You really are.
Which brings us to arguably the most compelling reason to trust this turnaround. The aggressive alignment of incentives at the top.
Oh, this is my favorite part of the call.
The compensation structure for Jan Kreps, the new executive chair driving this entire structural overhaul, is perhaps the strongest signal in the entire earnings call.
It absolutely is.
Because Kreps takes absolutely zero annual incentive bonus.
None. Zero.
No cash bonus at the end of the year if he hits some arbitrary board-approved revenue target.
None. He stated unequivocally that his compensation is entirely tied to the long-term performance of the stock price.
Oh.
Furthermore, he highlighted his significant personal investment in Weston shares, stating bluntly on the call, and I quote, "I am rewarded if you, our shareholders, are rewarded."
You cannot ask for better corporate governance than that.
No, you can't.
When the executive holding the pruning shears only makes money if the equity value of the company increases,
Yeah.
you can guarantee he's going to cut the exact right things, and he isn't going to build empires just for the sake of top-line revenue.
Exactly. And he is forcing that exact same accountability down the corporate ladder.
Really? How so?
The wider executive management team is now heavily compensated based on return on invested capital, ROIC, and free cash flow generation, rather than just basic revenue growth.
Well, that's huge.
It ensures the management team won't try to buy unprofitable market share overseas just to make the company look bigger.
They are financially incentivized to shrink the footprint if it expands the cash margin.
Exactly.
So to summarize the Talk Ticker's verdict for our listener today,
Let's hear it.
if you buy Weston, you are buying into a massive $900 million operating cash flow machine that possesses a highly resilient market share stealing moat in North America.
Right.
While you wait for the international turnaround to execute, you are getting paid to hold the equity via a solid, reliable dividend. They just announced $1.38 per share quarterly payout, by the way.
Which is nice.
Yeah. And you're ultimately betting on a new, highly incentivized AB InBev trained leadership team that is actively ripping out the international deadweight and implementing a ruthless zero-based cost culture.
It is a textbook setup for a patient, value-oriented investor who is willing to look past the messy, short-term headline numbers to find the structural improvements compounding underneath the surface.
It really requires looking at the business not just as a simple manufacturer of French fries, but as a complex network of capital allocation, thermodynamic efficiency, and global supply chain mastery.
Well said.
Well, listener, we have reached the end of this deep dive into Weston's Q4 earnings. We've unpacked the power of the North American engine, the drag of the international parachute, and the sheer mechanics of turning a raw potato into free cash flow.
It serves as a vital reminder that in public equities, the simplest products often hide the most complex operational realities.
They really do. Before we let you go, I want to leave you with one final, slightly provocative thought to mull over.
Ooh. Hey.
We spent this entire deep dive talking about the gritty, physical realities of farming, freezing, and shipping.
Right.
But during the Q&A portion of the earnings call, management briefly hinted at a strategic pivot toward technology.
They did.
specifically noting they are looking at leveraging the potential of artificial intelligence to become ever more efficient over time.
It was a fleeting mention, but dropping AI into an agricultural manufacturing call signals a fascinating shift in how they view their future margin expansion.
Exactly. So here is the question for you to explore on your own. How exactly will artificial intelligence reshape the legacy, dirt under the fingernails business of farming and frying potatoes?
It's a great question.
Think about the operational leaks we discussed today. Could a perfectly optimized AI-driven agricultural model that predicts crop yields based on microweather patterns and soil sensors eliminate that $33 million potato write-off entirely?
It's entirely possible.
Could AI-automated global freight routing instantly pivot ships around geopolitical conflicts in the Red Sea, saving millions in fuel and spoilage?
When you combine the predictive modeling capabilities of AI with their new zero-based cost culture, the potential for driving out systemic waste is truly staggering.
It really is.
I mean, they could model the exact thermodynamic efficiency of every single fryer in their global network in real time.
The future of the humble, perfectly golden French fry might be a lot more high-tech than we ever thought possible.
Seriously.
You know, we started this deep dive talking about how simple a French fry seems on the plate.
Yeah.
But as we've seen today, ensuring that fry gets to your plate profitably requires navigating Middle Eastern shipping lanes, European green energy mandates, rigid agricultural cycles, and brutal zero-based corporate budgeting.
It turns out there is absolutely nothing simple about a potato at all.
A fascinating reality to keep in mind the next time you order from a drive-thru.
Definitely.
Thanks for joining us on this deep dive, and keep digging for the data.